Okay, in this video, we're going to go through income tax disclosures. So we'll go through what you'll see on a typical income statement and income tax footnote, and we'll see what we can learn about a company by reading those financial statements and footnote disclosures. And let's take a look. The company we're going to talk about is Amazon. And we're just kind of, as we learn about the disclosures, we'll just kind of evaluate one of the claims that Amazon made somewhat recently. I think it was like during the previous presidential election. And the article here on some CNBC website says, why Amazon paid no 2018 US federal income tax, okay? So there was this big, there was a outcry for Amazon to pay their fair share in taxes. And so even Joe Biden commented on it. He said, I have nothing against Amazon, but no company pulling in billions of dollars of profit should pay a lower tax rate than firefighters and teachers. We need to reward work just well. And Amazon replied to the Biden Twitter tweet, and Amazon said, we've paid $2.6 billion in corporate taxes since 2016. We pay every penny we owe. Congress designed laws to encourage companies to reinvest in the American economy. We have $200 billion in investments, blah, blah, blah. Okay. So they say maybe Biden's complaints with the tax code, not Amazon. So let's what we're going to do is, as we look at Amazon's disclosure, we're going to evaluate the claim that they've paid $2.6 billion in corporate taxes, okay, since 2016. So here is the Amazon income statement. You can see they have product sales, service sales, they've got operating expenses, operating income down here, working my way down, interest income, interest expense, other, total non-operating income. And now we arrive at this line item called income before income taxes. And sometimes you'll hear this referred to as pre-tax income. And what happens right after pre-tax income? They pay their income tax. So right below it is called the provision for income taxes. And let's just call this tax expense. And a little confusing about the Amazon income statement is that they each year is to the right of the past year. So some other companies do it the exact opposite way. So the most recent year, 2019, as of this video, 2019 year is on the right side of this income statement. And you can see that they had pre-tax income of $13,976. And on that GAAP income, they recorded income tax expense of $2,374. And so what you can compute on this income statement is the most important ratio having to do with income taxes, the effective tax rate, or the ETR. And so we can calculate the ETR. It's equal to tax expense over pre-tax income. Okay, and we've done that here for the past 3 years leading up to 2019. They had a 20% effective tax rate in 2017, 11% in 2018, and 17% in 2019. And you may or may not remember that, but prior to 2018, I think it was, the US federal statutory tax rate on corporate income was around 35%. And you can see Amazon only paying 20% in terms of their ETR. They are not, it seems like they're saving money in some way. For some reason, they are using the rules such that they only have to pay a 20% effective tax rate, where the statutory tax rate is 35%. And then the Tax Cut and Jobs Act, and I think started in 2018, and it was still in effect for 2019 and even today, that reduced the statutory tax rate from 35% down to 21%, and you can see that their ETR took a nosedive as well. So they had an ETR of 11% in 2018 and 17% in 2019. So yes, they do have a very low effective tax rate. It seems like the cost of taxes to their business is not as high as it would be if they just paid the statutory tax rate. So we'll see if we can learn a little bit more about that. First, we're going to go to their cash flow statement. And not in so the bulk of the cash flow statement is in these 3 categories, as we've learned before: operating, investing, and financing. But companies also disclose supplemental cash flow information that isn't really disclosed on its own anywhere else. And the one we'll focus on is this cash paid for income taxes. So companies disclose that. How much cash, so not how much expense did you recognize, how much actual cash did you send to the government for taxes, okay? And that's what they're disclosing here. 2017, it was 957 million. 2018, 1.1 billion. 2019, 881. And if you remember that tweet, they said since 2016, we've paid 2.6 billion in corporate income taxes. So I'll add in 2016 here. I went to the 2016 cash flow statement. It was 412 million. So if you sum up the three numbers before that tweet happened, so the tweet, this is when the tweet happened. Okay, so I'll put T for tweet. So when the tweet happened, yes, in the past 3 years, they did pay 2.6 billion in corporate income taxes. Okay, so fact check true on that tweet, I would say, according to their cash flow statement. But let's see what else we can learn about this from the footnote disclosure. So at the top of so here we're at footnote number 9 for income taxes. And usually the first table that you'll have in that footnote is a breakdown of income tax expense. So you can see this table here, the bottom of it is the provision for income taxes. And if you remember, that is what we called income tax expense on the income statement. So remember this 2374 from the income statement. I'll go back and show you. There's that 2374 provision for income taxes on the income statement. And so what this table is doing is it's breaking down what makes up that number. And the biggest level that they break down is the jurisdiction, okay? So they have U.S. federal jurisdiction, U.S. state jurisdiction, and international jurisdictions. So taxes that they owe to the U.S. federal government, the state governments that they operate in, and other countries outside the U.S. Okay, that's what international refers to. And then within each of those jurisdictions, they have two different components, current and deferred. Now, when they say current, what they mean is this is the actual tax bill for that year. So I'll write tax bill. When they fill out their tax return, at the bottom of it, it tells you how much do you owe the government. Wow, that's an ugly X. Let me redo that X, the tax bill. So when you fill out the tax return, at the bottom of it, it says, here's how much you have to pay to the government for operating during that year. And that's what these numbers represent, okay? So these numbers here, minus 137, minus 129, and positive 162, that's the amount that they owe to the government. The deferred line item, that's an accounting entry, okay? We use deferred tax assets and deferred tax liabilities to smooth out the effective tax rate so that it only is impacted by permanent book tax differences. So this deferred item here, this is just an artifact of the accounting system. So I'm going to write accounting by that. We just use that component of tax expense to smooth out the effective tax rate. So if I had to say the journal entry for the 2019 year, what would that look like? Well, total is going to be, and this is just going to be for U.S. federal. Total tax expense, this is total expense, on the income statement, right, because these all add up to the income statement number, is 1076. There was a current portion of that, 162, that we owe to the federal government, and a deferred portion that just is feeding into our deferred tax assets and liabilities. So here's what the journal entry looks like for that 2019 year. Tax expense is 1076, and that 1076 has two components. The first is called tax payable because we actually owe that money to the government. Okay, that's a current obligation of the company. And the second is, I'm calling it just a deferred tax liability, right? This is just going to be temporary on our balance sheet just to smooth out the effective tax rate, as we've discussed in previous videos. So that's what the journal entry would look like. And now I've highlighted certain components of this U.S. federal section here. What does it mean for, in 2018, there's minus 129 million in the current portion? Well, that minus 129 million is actually a tax refund owed to Amazon. So the federal government actually owes Amazon money as a result of their operations during 2018. That's what that minus 129 means, okay? And that I could see would be pretty aggravating to see that, to see a profitable company being owed money by the U.S. government. And that deferred portion is just a deferred tax entry. It's what we use to smooth out the ETR, okay? That was that component of 2018. 2019, the sign flips, it's positive 162. So at least in 2019, Amazon actually owed money to the U.S. government for the operations during 2019. Okay, so that's what that means. Something else we can do, and we can use the table below here. They give you the components of income before income taxes. So this is pre-tax income. We can calculate ETRs for individual jurisdictions. So for example, we can compute the ETR for US jurisdictions, which would be, this one, US state and US federal. How would we do that? Well, we just take tax expense for that jurisdiction, and we divide by pre-tax income. So tax expense is the 1076 plus the 284, and pre-tax income is right here, 13,285. So we can calculate a US ETR of 10%. And you can compare that to the company-wide ETR or to the international ETR to see where does the company operate, where does it cost, in terms of tax, where does it cost the least amount for the company to operate. Okay, you can use this table to estimate that. Okay, moving down to disclosure, we come to the last thing I wanted to talk about on this disclosure is, so where does that 2.6 billion fit in, right? Those are actual payments to the government. So it's more closely related to these current line items. The current portion is the amount you actually owe to the government. Well, if you look in the most recent years, where does the company pay or owe most of their tax bill? And in terms of actually owing it during that year, it looks like most of their payments are going to international jurisdictions. Meaning, so if you go back to this tweet, when they say we paid 2.6 billion in corporate taxes, they intentionally leave out, they're not referring, this is mostly not to America, right? Not to the US. They're mostly paying these corporate taxes to international jurisdictions, okay? So they leave that out, which I think is probably important information, especially if you're running for president, right? You care about how much tax they're paying here. So I think that's something interesting we can learn from this footnote. Okay, moving down in the footnote, we get to the rate, this is called the rate reconciliation. It gives you the difference between so at the top of this table here, I can just read this. The items accounting for differences between income taxes computed at the federal statutory rate and the provision recorded for income taxes are as follows. So here's that 2374 again, as you remember. And what is this 2935 up at the top? Well, that's what income tax expense would be if it was computed at the statutory rate. And that in 2019 was 21%. So this table answers the question, why isn't the effective tax rate 21%? Why isn't the cost of taxes to Amazon 21% of their pre-tax income? This table answers that question. And there's a couple different reasons for it. These are all permanent book tax differences, okay? Because they by definition affect the ETR. And I'll just plug in the ETRs here. So these, the yellow boxes on top, they show you the federal statutory tax rates and how they decreased from pre-2018 to post-2018. And here's the actual effective tax rate that you compute on the company's income statement. And let's just go through the first three permanent differences here, okay? So the first permanent difference is the tax impact of foreign earnings. And you can see that that's a positive number. So that increases tax expense above what it would otherwise be. And that just means that they actually pay higher taxes in foreign jurisdictions, okay? They pay higher tax rates in countries outside of the US. That's what that positive number means. It has a positive effect on the effective tax rate of the company. Similarly, state taxes, well, the yellow boxes above here, right? This is the federal statutory tax rate. Well, if you operate in a state, you have to pay taxes over and above the federal tax rate. So to the extent Amazon operates in states where they have to pay additional taxes, that's going to have the effect to increase their effective tax rate over just the simple federal statutory tax rate. And finally, we'll go through one negative number, which has to do with tax credits. So certain of Amazon's, research and development activities, maybe domestic manufacturing activities, to the extent they have that, the U.S. government wants to incentivize those activities. And so in some cases, you can reduce your tax obligation by engaging in activities that the government wants to incentivize. And so those activities result in tax credits, and those tax credits reduce the cost of taxes to the business because the business is engaging in those desirable activities, let's call them. Okay, the final section of this footnote is going to be an important table, and this has to do with the accounting side of this, okay? These are our deferred tax assets and deferred tax liabilities. So these are just tracking all of those temporary differences, okay? This table has to do with temporary differences. For example, a loss carry forward, the top line of deferred tax asset. Why is that an asset? Well, we had losses in the past, and rather than just having tax expense of 0, we wanted to maintain a good effective tax rate. So we actually recorded a negative tax expense in a prior period when we had losses, and we set up this asset. What is the nature of the asset? Well, we're going to be able to use those losses to offset future taxable income. So it's going to reduce our tax bills in the future, and we're holding it on our balance sheet as a deferred tax asset. And so there's the deferred tax asset balance. We'll go through one more maybe, accrued liabilities. What's the idea here, being an asset? Well, accrued liability means we haven't paid our supplier or whoever we owe the amount to. We haven't paid that yet. And usually for tax purposes, we can't deduct an expense until we pay it in cash. And so even though we've recognized the expense on our income statement, it's not a deduction on our tax return. So what is the nature of that asset? Well, sometime in the future when we pay it, it's going to be a deduction on our tax return, and we're going to get to pay less in income taxes. But we don't want that to show up as a sudden drop in income tax expense, right? We're smoothing out that income tax expense. So we hold this amount as a deferred tax asset until we actually pay and we get the benefit from the asset. Last on the deferred tax asset section, I want to go over this valuation allowance. So what do you need to benefit from these deferred tax assets? So these loss carry forwards and these accrued liabilities. What do you need to benefit from them is future taxable income, right? You can't save money on income taxes unless you actually pay, unless there's some risk of paying income taxes. And what do you need to pay income taxes? Income. And so to the extent a company thinks they're not going to generate income in the future, well, these aren't really assets, right? Because they're never going to get to benefit from them. So this line is actually an estimate. And it's a very informative estimate because it tells you, does management expect to have future taxable income? And you can see that in certain circumstances, they don't expect to be able to benefit from these assets, meaning they're not going to have taxable income to benefit from some of these assets. And that should be interesting to you as an investor when a company is saying we're not going to have sufficient income, right? That means they're going to have low amounts of income. And footnote 2 tells you that this valuation allowance relates primarily to deferred tax assets that would only be realizable upon the generation of net income in certain foreign taxing jurisdictions. So they've got certain foreign jurisdictions that are just loss-making, and they might not ever have taxable income in those jurisdictions, and so they might not ever be able to benefit from those carry forwards, and so they reduce, you can see they're reducing the asset value on the balance sheet to be honest with investors that, yeah, we have these assets technically, but we might not benefit from them. So they reduce the value of the asset from 8.7 billion down to 3.7 billion. And kind of the same idea for deferred tax liabilities, so I won't go through those in detail. And that's it. That should be the end of the income tax footnote for Amazon, and a lot of things you can learn about the economic activities of a company by really carefully examining their footnote.